The RBI governor addressing at an event talking that the financial resilience is actually linked to the bank's business model and strategies. Also said that the banks need to be organizationally resilient. Also, he said they are expecting the bank management to keep assessing the risk. An Indian banking system is resilient amidst the US banking crisis.
The recent developments in United States in particular, there is again questions about whether the business model of individual banks that have faced challenges, that have faced difficulties, whether their business models were right. There are questions being asked all around, but I am not going into that. Because these business models sometimes can sort of create risks in certain parts of the balance sheet of a bank, which going forward can blow up into a bigger crisis. So therefore, we are focusing now on the business models adopted by the banks, and I will touch upon it a little later in more detail. The Reserve Bank has put in place various prudential regulatory frameworks. These include, as is well known, capital adequacy requirements, asset classification, provisioning requirements, even dividend distribution and liquidity management framework, etc. In addition, the Reserve Bank also periodically deploys macroprudential measures to address system-level buildup of risks. As a consequence of the measures taken by the Reserve Bank and the banks themselves, I must mention here, the Indian banking system has remained resilient and has not been affected adversely by the recent sparks of financial instability seen in some advanced economies. This also comes out clearly in our recent stress test results. The gross NPA ratio, that is the gross non-performing asset ratio for the scheduled commercial banks in India, was 4.41% at the end of December 2022, down from 5.8% on March 31st, 2022, and 7.3% as on March 31st, 2021. The CRAR at 16.1% at the end of December 22 is also much above the minimum regulatory requirement. Macro stress tests for credit risk indicate that scheduled commercial banks would be able to comply with the minimum capital requirements even under severe stress situations. Nevertheless, recent events in the banking landscape of the United States and Europe suggest that risks for an individual bank could crop up from segments of its balance sheet which might have been considered relatively safer. Hence, we expect the management and board of directors of each bank to continually assess the financial risks and focus on building up adequate capital and liquidity buffers, even beyond the minimum regulatory requirements. And this is required for continued resilience and sustainable growth of individual banks and financial entities. Now, turning to operational resilience, let me say that operational resilience would mean that a bank should be able to deliver critical services even in face of disruptions. Cyber risks and possible cyber attacks are on top of the list so far as such disruptions are concerned. Cyber risk has been identified as the foremost in top 10 operational risks for 2023 based on a global survey of financial institutions. The Bank for International Settlements, that is BIS, while revising the principles for sound management of operational risks in 2021, introduced specific principle on information and communications technology, that is ITC risk management, reflecting the importance of this risk. Robust IT and information security governance would help in increased predictability and reduction of uncertainty in operations, minimize losses from information security related incidents, and enhance operational resilience. Given the extensive level of outsourcing being done by the banks and by other financial entities, there is even greater need for ensuring that effective policies and practices are put in place in this regard. Even the G20 finance ministers and central bank governors are focusing on risks arising from third-party dependencies. The Reserve Bank has taken a slew of measures in recent years with usage of advanced analytical and surveillance tools, along with techniques like phishing simulation and cyber reconnaissance exercises to push for enhanced IT and cybersecurity governance processes in banks as well as in other supervised entities. In the context of growing exposure of our regulated entities to various risks from dependencies on third parties which provide technology and IT-enabled services, the Reserve Bank has recently, that is on 10th April this year, just about 20 days ago, the Reserve Bank has on 10th April issued comprehensive guidelines on information technology outsourcing by banks, NBFCs, and other regulated entities. Now, the third component of resilience, I mentioned about financial resilience, organizational resilience. The third component of resilience for banks and others is to I think I mentioned about financial resilience, operational resilience, and the third component is organizational resilience. So let me now focus on organizational resilience in brief. Banks and other financial institutions also need to be organizationally resilient so that they anticipate risks early and absorb them efficiently. Organizations must have the capacity and resilience to protect themselves from adverse incidents and shield their balance sheets. To achieve organizational resilience, regulated entities need to continuously evolve by standardizing policies, processes, organizational culture, and governance. They must also be flexible enough to encourage diverse ideas and innovations within the organization. You see, there is one thing, the institution by itself should have the inherent organizational resilience to withstand crisis. And I elaborate upon it a little more as I elaborated, I will, delve in greater detail on this as we go forward. Now, let me just also in this context touch upon the pillars of Reserve Bank's regulatory and supervisory strategy. An important element of our strategy of making the Indian financial system, including the banking system, future ready is the robust and enhanced regulatory and supervisory framework which we have put in place. Our present approach to regulation and supervision has been built essentially on three pillars. First, one of our focus areas in recent years has been to strengthen governance and assurance functions within the regulated entities. The safety and soundness of the banking system relies critically on effective governance so that interest of all stakeholders, especially the depositors, are duly safeguarded. The essence of good governance is to build an environment of trust, transparency, and accountability. Depositors, whose money represents an overwhelming part of banks' resources, keep their life savings and hard-earned money with the banks. Protection of depositors' money is therefore a sacred duty which has to be fulfilled through good governance. There cannot be any compromise on this. The Reserve Bank is very particular that regulated entities have systems and processes that promote sound corporate governance. The assurance functions, that is, risk management, compliance, and internal audits in banks are critical links between governance and business. Assurance functions assist the board as well as the senior management in gauging whether the business operations of the bank or NBFCs are being run in conformity with the policies and strategies laid down by the board. The Reserve Bank has issued detailed guidelines for ensuring quality and independence of the governance and assurance functions. These areas are also subjected to intensive supervisory assessment.